All right. Well, MFD, Mayfield Childcare. Tony. Oh, now I've got a funny... no, that's fine. Don't worry about that. Mayfield Childcare, what do we know about them? They're childcare centre owners.
They are in New Zealand. So this is also one of these companies that have dual listings. So they list in the ASX, but I think they're also listed over in New Zealand as well. And their market cap's low, and there's about $16,000 average trades per day.
Husband and wife team, I think, running it too.
Okay.
Had a bit of a look. Let me start that again. Had a bit of a look into them. Looks like an interesting setup. Okay. Well, we'll see how QuickFS goes this week with the latest financials. I'm not hopeful, but we'll see if it's up to date. So in terms of net operating cash flow, what have you got?
Okay, so this is December 19, 7.6 million, 760239.
Oh yeah, December 19.
Mm.
So that's actually their period end date.
Correct.
Right. Is that a New Zealand thing?
Well, no, it's an ASX thing. Most companies in Australia have. Oh, I see. I see what you mean. June or December.
It's their financial year end date.
I don't know.
I believe.
I don't know.
Right. So let me just update this to financial year figures in the spreadsheet. Oh, look at that, 7.6 million. That's what you said, right?
It is, yeah.
Good. All right. Shares on issue. I've got about 31.8 million.
Yeah, I have the same.
Gives me a cash per share of 24 cents. The share price, according to my spreadsheet's about $1.01.
Oh no, I have $1.11.
Go over to the ASX. Yeah. Why is that not? Has that changed since yesterday?
Don't think so.
Yeah. For some reason, QuickFS is giving me dodgy number. All right, well, I'll change that manually. $1.11 gives me a price to cash ratio of 4.65.
Yep. Nice and low.
Just going to bag that as manual entry. Okay, well, that is, nice and low, well below 7 that we're looking at. So it gets a 2 on the checklist. So, again, for new subscribers, still getting your head around the checklist and what it all means. I have to remind myself that we have lots of new subscribers every week. Price to cash ratio is telling us how many years it's going to take for the business to earn back the amount of money that we're spending on a share, using the cafe analogy that we use a lot. If I had an opportunity to buy a cafe for $1.11, let's say the entire cafe was going to cost me $1.11, based on the amount of money that it's generating, the cash flow, it would take 4.65 years to generate enough cash flow to neutralize the price that I'm paying for.
Yeah, to get your money back. And hate to be picky, but we're talking about operating cash flow. So in the cafe analogy, we're talking about the receipts taken at the till for selling coffee and the cost of collecting those receipts. We're not talking about anything else that might be needed by the cafe, like if in 3 years' time it needs to fork out for a new cappuccino machine from Italy or something like that.
So it's not profits, it's
correct.
Just cash flow.
It's operating cash flow.
Operating cash flow, right. Thank you for being picky. Okay, and we're generally looking, the reason we're asking, is it less than 7? One of the things that you found over the years is that this 6 to 7 year time frame is below that is it's a risk minimization approach, right? It's a bit of a buffer safety margin. Anything beyond that, it's too far out in the future. No one can, the longer it takes for the business to generate enough operating cash flow to neutralize the cost per share, just the more risk inherent in, where that business is going to be or where its industry sector is going to be, etc.
Correct. I mean, to use the cafe analogy again, the biggest risk is that someone opens a cafe that's better next door. So that risk is always there. And just to sort of belabor the point a bit further, it means that we don't pay 100 times operating cash flow on the promise that next year there'll be a lot more growth and there'll be a lot more customers. So again, that's a risk that I'm not prepared to take. Yeah, we're being quite greedy here. We want our money back as soon as possible.
And you're being conservative.
Yeah.
It's part of the low risk factor of your investing methodology.
Correct. And why 7? I think you've asked that in the past. It's really just a number. Price to cash flow of 6 came about from one of the books I've read in the past about investing. The guy who set up Cap Cities, which is one of the largest networks in the US, went about buying up TV stations around America, paying no more than 6 times price to operating cash flow. So that's where I got that idea from. It just also happened that once I dumped all the results out of Stock Doctor into a spreadsheet and then ranked them all by price to cash flow, anything more than about that, you start to get a portfolio that's quite large. So I'm trying to keep a cap on the number of stocks we're dealing with here to do more detailed analysis with.
Okay. And then next question is, does it have a positive trend? We're looking at the sentiment. I'm going to flip over to my charts in Reuters. I did this last night, and I did a 5-year monthly, and as I recall, it's a bit of a monster smiley face here, as I like to call it. Stephen like that. If I look at, if I do some high points, it was sort of at a peak back in February, March 2017. It came down, but then it's sort of bottomed out around about October 18 and has been creeping back up since then. So, yeah. So I would say it's a positive sentiment and a recent upturn?
Yes, that's right. Yeah, so the upturn really established itself, I think, around about November, December last year.
What do you mean? Why then?
Yeah, so if you draw a line, you can see probably on your graph the same as mine. There's kind of 3 peaks on the way down. The first one is February 17, then June 17, then February 18. If you draw your line through those, there was a breakout that initially happened January 19, but then the share price retreated back below that trend line March 19, and it went up above that trend line again in July 19. So maybe a bit early, maybe July 19 it started to establish itself.
Right.
Yeah. And if we're going to use July, we can't say it's a recent upturn, by the way.
Oh, really? How far are we allowed to go back for recent?
Well, 6 months is what I take it, so the period for the most recent results.
Okay.
But there is an alternative here, and if we take the line that goes down from, again, February 17 to that high point almost at the bottom of the trough in February 19, and if we draw our line across that, then the breakout occurred in December 19.
Okay, hold on. Let me try that. So, get rid of these lines. So, February 17, you said, through to February 19.
Mm-hmm.
Okay.
And then that crosses at November 19. That line.
Yeah. There.
Yeah, so there's no right or wrong answer to this, really. It's in an uptrend. It's just the question if we think it's recent or not.
Right. And you're saying no.
It's a line ball call. Let me look at what I put in my spreadsheet. Hang on.
Oh.
Oops. Okay, let's have a look. Oh no, I said yes.
Okay.
Yep.
All right. So it gets a 2 for positive trend and an additional 1 for a recent uptrend. Recent upturn. Dividend yield. I might have to change my term here. Oh no, I've already got it for FY. I'm getting 7.21%.
I'm getting 6.95, so not too far off you. I just noticed the share price has gone up to $1.11.5 now, so that might be the difference between our yields.
Oh, okay. Yeah, not according to the ASX.
Okay.
It's still 1.11. PE, dividend yield. Dividend yield, nothing on ASX.
I think that's wrong.
Yeah. Share analysis, dividends. Dividend yield 7.7, which is closer to me than you. But anyway, I'll take it at what it is.
We're only
7.21 on my sheet.
Yeah, sure, that's fine. We're only a couple of points away.
Yeah. So is that higher than the mortgage rate? Yes, it is. Gets a 1. PE ratio, QuickFS is telling me 5.2.
Oh.
ASX is telling me 10.49. Share analysis is telling me where 9.4.
Yeah, so I get 10.4 as well. And 9.4 was the PE at the time of the results, is what Stock Doctor was telling me.
Right. So I could be calculating my own here, and I'm not. Let me try calculating my own. So it's just the price divided by the earnings per share, right?
Correct.
Which
we'll probably have different numbers there as well.
Yeah, probably. 12 cents on my spreadsheet.
Yeah, 10.6 in Stock Doctor.
All right, well, I'm going to go with mine, see how it changes as we drill down into the financials. So that would give me 9.11 something. Which, what have you got? 10?
I've got 10.4.
Okay.
So not a huge amount of difference anyway.
All right. Either way, not less than the yield.
Correct.
So it gets a blank.
Mm-hmm.
Yes, on that checklist item. All right. So we're looking at the PE history. I should make a note here. PE history. I'm getting a lot of zeros.
Oh no.
Here.
No, I've got going backwards from today, 10.4, 9.4, 8.7, 7.8, 7.5, 8.3, and then 19.8.
Okay. Can you say that slowly?
Yeah, sorry. So as of today, it's 10.44.
Yeah. Before that, 9.4.
9.41, yep, which is the December number.
Yep.
Before that,
Yep.
8.71.
Right.
7.83.
Yep.
7.57.
Yep.
8.38. And lastly, 19.83.
Oh my goodness. Okay. So is it the lowest PE in the last 3 years? No.
Correct.
So it gets a 0.
Mm-hmm.
Net equity. What have we got here? I'm getting 28.5 million.
Yes, I have the same number.
Ooh. Now going backwards, I got 26, 24, 20, and then blanks.
Are they half numbers or annual numbers?
Half numbers.
Okay, because Going backwards, I have the current one, December 19, 28.5. Then before that, June 19, 26.1. December 18, 27.1. June 18, 24.3. And 24.1, then 21.6 back in June 17.
Oh, that's weird. Actually, I'm getting okay. Still there?
I am, yes. Sorry, I was just about to have a sip of tea.
You muted every time you have a sip of tea?
Yeah.
Wow. Hardcore. Okay, so I don't know why I'm getting these Excelers freaking out with some of these earlier numbers back in 2017. But so with your numbers, does it have consistently increasing equity?
Unfortunately not, almost. So, but no.
Oh,
Yeah,
really?
so
Okay.
so December 18 was 27.1, June 19 was 26.1, which goes backwards, and then December 19 is 28.5.
Okay. Well, my numbers are problematic here, so I'll use your numbers. Now, share price, I'm going to compare it to net equity per share in a second. I've got net equity per share, aka book value, of 90 cents.
I'm just looking that up.
Taking our net equity number of 28.5 and dividing it by number of shares on issue.
Would you have 90 cents? Yeah,
Yeah.
that's what I got too.
Okay.
Mm-hmm.
Now, that is not less than the share price.
Mm-hmm.
So gets a blank for that on the checklist.
Correct.
And again, for new subscribers, new people drilling into this, still getting their head around it, what we're looking at is equity, assets minus liabilities. If we had a cafe and we had to liquidate the cafe today, sell all of its assets, including the coffee machine and the till and the chairs and the tables, and we had to pay off all its liabilities, how much money would be left to spread amongst the shareholders? And ideally, I mean, in an ideal situation, there would be more money left over than you have to pay to buy the business. If you had a fire sale today, that would be a good situation for an investor. You know, okay, well, I'm investing in the business, but if I have to liquidate it tomorrow, I'm going to come out on top.
Yeah.
So you'd give it a point for that, but we're not in that situation in this scenario. But we're not far off it. Honestly, 90 cents to $1.11, pretty good.
Yeah.
Pretty close.
Yeah. And it's less than our book plus 30% threshold too.
Yeah. So it's about 24%. The price is about 24% higher than the book value. And again, the 30% number is it's just again a risk factor, right?
Yeah, and it comes from Warren Buffett, who's said many times in the past that he's prepared to buy back Berkshire Hathaway shares when he thinks they're 30% or less above book.
Right.
So that's his risk minimisation strategy, I guess.
Right. Okay, so net profit after tax. Where am I? Oh, well, these numbers are going to be wrong because I've cut and pasted the QAV numbers from last week. Sorry.
Okay.
Hold on.
QAV.
That's what is going on here. Okay. All right. I'm getting net NPAT of 6.154 million.
Really? I've got 3.362.
God, that was closer to the QAV one. I shouldn't have bothered changing it. Okay. 362?
3.362 million.
Okay. Deary, deary me. Let me just... okay. Maybe if I change that to financial year from TTM, I mean, it should be the same thing, but I'll change that to financial year as well. And then I will... Oh, yeah, no, this is looking better, Tony.
I think our numbers will be slightly different because we had different earnings per share numbers before.
Well, I'm calculating mine out of QuickFS by taking the pre-tax profit and minusing the income tax, and I get 3.346.
Okay, pretty close.
So, pretty close.
Yep.
See, I got a system, Tony. I just have to. I just have to tell, because depending on the time we're doing this and where we are in the reporting period, I have to go into my spreadsheet and tell it to look at TTM or financial year results or financial quarter and all that kind of stuff. So anyway, all good. Well, that gives me an earnings per share of about 10 cents.
Yep, 10.6 is what I have in Stock Doctor.
Okay. Now, in my sheet, I compare that to the cash per share that we calculated earlier, which was 23 cents, which means my return on equity, my earnings per share divided by my equity per share, is about 12%.
That's what I have too.
Now, looking at the future predicted earnings per share in share analysis, for the period ending December 2020, they are saying 13 cents.
Oh, really? Okay. Because they're not giving us an IV, a future IV. Stock Doctor doesn't have earnings per share future in it at all.
Right. Yeah, no, you're right. Share analysis isn't giving us an IV, are they? That's peculiar. Well, I guess we'll go with it because it's there. Although they do flag in share analysis, the number of analysts providing forecasts is limited.
Makes sense.
Doesn't tell me how many there are, but yeah, it's a small cap company, right? So, as you've said before, they don't tend to have a lot of coverage.
No, that's right.
Because they're not worth a lot of money to stockbroking firms.
Correct. It's true.
Yeah. And that's to our advantage, right? Because we might be able to find opportunities that no one else, people who are listening to stockbrokers tell them what to look for, won't be getting much coverage of this for the reason I just mentioned.
Yeah, correct.
Well, that gives me a growth of earnings per share over PE of 2.24.
So you said the future EPS was 0.13. Yep, I had 2.14 then, if I plug that in.
Right. Which is higher than 1.5.
Mm-hmm.
So it gets a 1 here, and I had the wrong numbers, so I'm updating my numbers, and I get a 1. Now, we had a question about this recently from Stephen, one of his millions of emails he sent us this week. And he was asking just to confirm if the growth of the earnings per share of the PE is positive but less than 1.5, do we give it a blank or a 0? Now, I said we give it a 0.
Correct, yes.
Yeah. It's not actually reflected in the current version of my spreadsheet, though. So if I'm going to make a note here, is positive but below 1.5 gets a 0. Got to just change my little formula. Okay, so gives me an intrinsic value number 1 of about just under 54 cents, 53.91 cents.
Check that. Yeah, I had 55.
Close enough. So that is obviously well below the current price, so it gets a 0 on the checklist for that. intrinsic value number 2, however, I'm getting 1.93, which is above the... Oh, what? Just got an error in my spreadsheet. Why am I getting an error? Ugh. All right, well, I'm going to give it a 1 anyway. How dare you give me an error when I'm live recording? How dare you embarrass me like this, Excel? Is it more than twice the current share price? No. So it gets a 0. All right, now we get into some other stuff. Is it a star stock on Stock Dr. Tony?
No, it's not.
Gets a 0. It's a C4 on share analysis, so it gets a 0 on that as well.
Yep.
Any current intrinsic value on Stock Doctor?
No.
Okay.
Again, too small.
Share analysis gives it 63 cents.
Yeah, but that's for the last half.
Well, isn't that current?
It's the current numbers, but what share analysis normally does is, so for example, we're now into the next quarter, next half, they would put their IV in for that, and that's the one I'm looking for. So we don't have an IV from share analysis as far as I'm concerned.
So it would be the 2020 number we'd be looking for.
Yes, correct.
Okay, so I'm going to give it a blank there. Okay, well, that should be a blank there as well. Okay, is the financial health from Stock Doctor stable or increasing?
Let me get back there. Yes, it's stable.
It's 1. Now, the next question is whether or not the CEO or a board member is a founder. I came to the conclusion that both the husband and wife are directors and executives and founders, so I think it should get a 4 for this, Tony.
I don't think we'll need it, but it should get a 2 at least.
Not a 4?
Not a 4, no.
Husband and wife? No? Okay.
And they both hold 19% of the company.
Right. Is the intrinsic value going up in the future? We don't have one, so it gets a blank.
Mm-hmm.
So, 12 out of 15, 80%, 0.17 QAV score.
Yeah.
Well, that's good.
Yeah.
That's the best one that we've seen in a while. Going back to Eclipse, that's the highest QAV score I've seen.
Okay.
We might have to dump Horizon and replace it with
well,
Mayfield.
We might, yeah.